Good afternoon, everyone, and welcome to another Barometer afternoon webcast. Thanks so much for joining us again. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And joining me, as always, is David Burrows, our Chief Investment Strategist and President at Barometer, with a special guest star, James Callahan, one of our key analysts on our desk, will also be joining us to talk about earnings and so far what we've seen in the financial services sector specifically. We will address questions at the tail end of this conversation. And with that, I turn the conversation over to David Burrows. Thanks so much. Good afternoon, David.
Hi, Pam. How are you? Nice to see your face.
Great. Thank you so much. Always a pleasure.
Well, it's another Tuesday afternoon, and I hope wherever you are out there, you are enjoying whatever stage of reopening that you are in. I think everybody's happy to be outside. I think everybody's happy to be thinking about other things than COVID, and things are slowly getting better. Lots of stuff to talk about today, so we're going to move fairly quickly. It's been an interesting few weeks. To summarize, we've seen some pause in some of the cyclicals over the last 5-6 weeks, actually 11 weeks. We've seen some good strength in some of the large cap growth stocks. The question is, what conclusions should we draw from that when it comes to leadership and as to what it is telling us about going forward? We've seen bonds pulling back, yields pulling back a little bit. We've seen lots of movement, and here we are headed into earnings. So we're going to try and make some sense of it by looking at some of the market internals and kind of talk you through the way we look at the world, which of course, everybody's got their own approach, but this one has helped us to stay out of the ditch over time. Just to kick off, as always, from a very high level, let's talk about macro themes. I think that you don't ever know exactly where things are going, but you've got a good idea as to what the structural backdrop is. And as you know, we believe we started a structural bull market for equities when the S&P and the Dow broke out to new highs in 2013. We're now 8 years into what is likely a 15 or 18 or 20 year structural bull market. This is the bull market of the 80s and 90s, the bull market of the 50s and 60s. Each of them had some significant pullbacks, but it's kind of 4 steps forward, 1 step back. And it's important to understand that because, as I've pinned on my Twitter feed, the hardest thing to do in a bull market is to stay in your winning positions. You will always be told we're at a new high. This must be the top. There will always be people who have an opposing view who want to scare you out of your positions. Similarly, in a structural bear market, the most important thing is to be a good seller. And certainly we had to be very defensive in 2008, and very defensive in 2001 and 2 in the tech wreck. And so understanding that the environment that we're in helps us to structure an overall view, and then we have to look at tactically what's happening in the short run. And from a rates perspective, as you know, we believe we've been going through a structural bottoming in yields. Yields have been falling since 1981 at the height of the inflation scare of the 1970s. Interesting enough, when rates started to go higher in the 10-year in the early 1950s, really important to understand, it took 15 years to go from 1.6% in the Treasury bond to 5.5, 15 years. And during that period, there was very little by way of persistent inflation. It was just some fits and starts, and you didn't actually get any significant inflation until you got into the 1970s. Of course, bond yields went sharply higher at that point. But we make the case that what works in rising rates in a reflationary environment are quite different than what works in a falling rate environment or a disinflationary world that we've been in for a long time, really as long as I can remember in my career. And so we have to keep an open mind as to what may work going forward. When we look at commodities, they have their own long cycles. We've been through a structural bear market in commodities relative to the S&P, and in absolute terms, we believe we've gone through a bottoming process over the last 6 or 8 months. And that likely we have a tailwind for commodity prices going forward. We've got lots of evidence that points to that. So just starting from the top, here's the S&P. And I've been using the period really since the beginning of November last year, which is really when the key themes kind of kicked in. The S&P has been in this very tight channel all through this period and slowly working its way higher. If we take a look at the equally weighted S&P, it's been quite similar. I'm just going to have to pause just for a moment because it looks like I've got the wrong slides on the screen. I'll just be just a moment. This looks like my deck from today. Okay, so here's the S&P. We've been in this channel really since the beginning of November, working our way higher. We've tested the top end of the channel, the bottom end of the channel, but really a remarkably trending market. We're right absolutely in the middle of the channel. If you take the lens back, though, it's really quite interesting. This was the breakout in 2013. We've been 8 years. Now, when a sector or a theme initially takes off, it's not every security within that asset class. It's not every group within that asset class, but there will be leadership off the bottom. When we look at the NASDAQ has also been trending since November very nicely, since the correction sort of through September, October. We take the lens back on that one. We broke out of this range we were in from 2000 in 2016. So NASDAQ has been in a structural bull market really only for about 5 years. When we look at the Canadian market actually has been acting very, very well since last fall. I think especially because of the cyclical nature of the Canadian market. You can see that every time it's pulled back, this MACD indicator has remained well above the zero line, which indicates, good strength, good persistent strength. When we take the lens back here, we know that the TSX really made no progress from 2008 until 2018. So really only 3 years into maybe a new structural bull market in the Canadian stock market. So equities as a whole have seen a broadening theme. We've seen markets around the world break out of ranges. Taiwan goes back about 10 years. Japan goes back 30 years in a structural bear market. But one by one, markets have broken out, and equity breadth has been pretty good. When we look at fixed income, we talked about the fact that we think we saw generational low back here in March of 2020 at the height of the pandemic. You had a pretty significant rollover here. We had a rollover in early summer last year, and here we are rallied in the bond market. It's a 30-year bond from March until recently. And we ran right into this declining 200-day moving average, and looks as though the price of bonds are rolling over. Yields are turning back a little higher. We'll see. But it's interesting during this period where yields rallied, bonds rallied, commodities pulled back a little bit. The cyclical stocks pulled back a little bit, and of course, growth stocks caught a bid. We'll talk a little bit about that. Here's the equally weighted Rogers Commodity Index. It only recently made a new high, and this consolidation goes all the way back to 2008. In fact, if we look at it, here's the downtrend that began. I like this index because it's equally weighted. It's not skewed towards energy in particular or metals. It's across all of the agricultural commodities, the hard commodities, and the precious metals. We broke out of the range about 7 months ago. And actually this range, the sideways consolidation, goes back to 2015. So it's 6 years, just recently poked our heads above that level. So structural bull market, we believe in commodities, very early stage. A sort of third inning structural bull market for equities, which of course will have some significant pullbacks along the way. And it looks as though we've just gone through sort of the first corrective phase in a down move in bond prices. And that's important because bonds have been in a bull market really since 1981. So let's look at some of the data from this week, some key points. Jobless claims came in sort of as expected, a little bit lighter. You can see that jobless claims have been coming down. We are not anywhere near where we were before the pandemic began. That gives the Fed cover to continue to be easy with policy. They've made it clear they want to see a resumption of sort of full employment, and that they're prepared to see some inflationary data because inflation has been below their target for so long. For it to be above for some period of time wouldn't be a problem in their opinion. This, I think, is very interesting. This is unfilled jobs or job openings. You can see that there's a mismatch right now in the US between the jobs that are available and those that are looking for jobs and the skills that they have. So that's going to be a challenge. But probably most important over the last week with the inflation numbers, the CPI data. CPI came in hot, 5.4% on the headline. Core CPI was a little bit below. That's about the biggest jump we've seen in a very long time. Important to understand the makeup. When we look at some of the contributors, sort of the pandemic affected services, have added to inflationary data, and actually data related to vehicles, new cars, used cars, parts and rentals, also very significant impact because it's such a broad-based input. And the other data, not quite as significant, maybe why the Fed is considering some of this to be transitory. And the market appears to be giving it a pass. Bond prices were a little bit lower today, really not very much. And there was very little reaction overall in the market to what could have been a fairly scary number for the market had it not expected a high CPI number. We're into earnings, and this is what earnings expectations look like. Estimates have been getting ratcheted higher fairly steadily. So as we go into earnings, it will be interested to see how much of this is baked into market prices, how share prices react going through the earnings period. Of course, we're in the blackout period right now for most companies, so they can't buy their own shares. One of the biggest buyers of shares is corporations buying their own shares back. So you sometimes get a bit of bumpiness leading into earnings. And then generally that bid comes back once they've reported. But we're into the beginning of the reporting period, and financials, of course, report first. You can see that, like some other groups, there's been about 11 weeks of consolidation in financials price. So we're going to look to earnings and the period 2 or 3 weeks following earnings to see how the market reads this. Now, historically, the market doesn't tend to like to pay up immediately for bank earnings. We've often seen them back off for a day or two after they report. But really, what we can take away from this period is not just how well the banks are doing and the financial services are doing, but what kind of commentary they can give us on the reopening process and the health of the consumer. So I've asked James Callahan to join us today, and we're going to start off just talking a little bit about what we got this morning from JP Morgan, Goldman Sachs, and First Republic, which is a large holding for us. So James, maybe you could give us a little bit of color, and maybe you start with JP Morgan.
Yeah, absolutely. And thanks, Dave. Always happy to join. This morning we had JP Morgan, Goldman, First Republic. Now with the results in the book, we do have a more complete picture of how the banks are handling, what seems to be the final stages of the pandemic in the US, and what they see for the back half of the year. So that's great to see, how well the banks are doing from a fundamental perspective. But these large bank earnings are doubly important because they do so much and they touch every aspect of the US economy that they really give some of the best read-throughs into the US economy that you can get. For example, JP Morgan processes a few $100 billion in card transactions every quarter. So they really do see it all. So from JP Morgan earnings, what did we learn? They beat a really high bar for revenue expectations by almost 5%. So they did over 31 billion in revenue during the quarter. And they beat on EPS expectations as well by 20%. So a sizable beat there, driven by a larger than expected reserve release. So to double click on some segments, investment banking revenues were very strong. Trading revenues were just about in line with expectations. All of their capital ratios were in order, so no surprises there. Firm-wide, their loan growth was flat, which was expected. So this is an improvement sequentially versus Q1, which was nice to see. The biggest headwind to loan growth does come from the fact that both their consumer banking customers and corporate banking customers are in very strong financial positions right now. Everybody's cashed up and they don't really need to borrow. To get into some of the economic read-throughs, JP Morgan told us that during the second quarter in their consumer banking segment, combined credit and debit card spend was up 45% year over year versus 2020, and up 22% versus 2019, just to give a pre-pandemic comparison. Travel and entertainment spend was up 13% versus 2019. Mortgage originations were up 64% versus 2020, and auto loans were up 61%. But despite huge strength in originations, loan growth for their consumer segment was down 3% year over year due to the amount of prepayments that they saw and just generally lower card balances. So if JP Morgan's customers are healthy, the average US consumer is healthy too, which was good to see. From Goldman?
Goldman. Let's talk about Goldman for a minute, because often we hear about Goldman's numbers and they either have hot trading revenues or cold trading revenues. And the discussion always is, if they have great numbers, what multiple should we pay for high trading revenues? I thought this earnings report was really interesting. Maybe you can give a little color on that.
Absolutely. And trading revenues, as you said, are very lumpy. They're not really justifiable of multiple expansion when you have a good quarter for trading. But this quarter, they put up a massive beat. So they did 15.5 billion in revenue versus 12.5 billion expected. Really good earnings, but the beat was driven by strength in their asset management segment. So that segment put up a record quarter with 5 billion in revenue versus just under 3 billion expected. So they actually more than doubled asset management segment revenue year over year, and grew 11% versus Q1 2021. So just, really, really strong results, and asset management revenue is justifiable of multiple expansion.
Just given the fact that it's recurring revenue.
Recurring revenue, and it's sticky. Yeah. So they now their assets under supervision is now it expanded 100 billion during Q2 to 2.3 trillion. So very, very strong. And then besides asset management, investment banking looked a lot like JP Morgan. They did a nice $600 million beat there. Record backlog there for them. So they did take some share from the other big players. Trading was in line, and it did shrink year over year because they did have an outlier quarter this time last year. They made a killing during the pandemic, and then net a great quarter. Asset management revenue is great to see that's where the beat came from.
Now, James, we focused a lot in some of the banks that have been able to grow their loan books. Jim Skatakis' view is that the banks that are able to grow organically probably should trade at a higher multiple, and ultimately will get treated better by shareholders. First Republic, I think, is a great example of that. Maybe just talk a little bit about their numbers and who they are.
Yeah, absolutely. So they're about a 1/12 of the size of JP Morgan. So they're a little bit scrappier. They can continue to grow and take some share when it comes to loan growth. So they are focused in the most populous states. So they have a presence in California, New York, Florida, Massachusetts, those kind of states. They do about 40% of revenue from home equity line of credit. And the other 40% is construction financing. And then the remainder 20% is just various different business lines. So they're exposed to some great verticals, and they all contributed to good results. So they work really hard to achieve top tier loan growth. This quarter, they grew loans 23% year over year, to contrast that against flat loan growth for JP Morgan, and that being an almost a perceived positive for the bigger banks to do flat loan growth. They grew 23% year over year, and they grew revenue and earnings by over 30%. And that's what they do in a normal quarter. So very strong business, and a good quarter from them.
That's great. Thanks very much, James, for jumping on. Of course, we're just right at the very, very early part of earnings reports. The one thing that we would take away is that expectation is for about 22% earnings growth for the S&P. And we will watch with interest not only what the numbers are, but how the market responds, and we'll update in future calls. Let's just talk a little bit about what we're seeing going on internally in the market, because of course we have our view as to where things look like they're going. We're always measuring to say, does the market agree with us? And what is happening internally. It's one thing to look at an index that's dominated by 5 or 6 or 7 very, very large companies like the S&P. But it's another thing to look at what's happening to the average company. And we talked about the past few weeks, the fact that some of our internal data, percent of stocks above their 50-day moving average and percent of stocks with their 150-day moving average or 30-week moving average have been a little sloppy. And we saw in some parts of the market, some companies breaking their long-term trends. And so we watched that for signs of progress. And here's some basic takeaways. We know that in February, the second month of the year, 72% of all the companies that trade on US exchanges were in long-term uptrends, as defined by a point and figure price chart. As we sit today, 52% of stocks are in uptrends. So we know that about 20% of companies have sold off and broken their long-term trends. And we're always watching that, which groups they're in, so we can be careful of our exposure in those areas. And of course, importantly, avoid putting any new money to work in those groups. If we take the NYSE on its own, 78% of companies were in uptrends in January. As we sit today, 60% are in uptrends, so some narrowing there. Percent of stocks in the S&P mid-cap index in uptrends has come from 82% to 50%. And the percent of stocks in the small cap index in January, 90% of stocks in uptrends. Today we're at 50%. So market has been doing some sorting good from bad. Some stocks pulling back within their long-term trends, some stocks breaking down. It gives us some guidance as to where the appetite is. And we watch these things very closely. Not just in the US, we've seen a little bit of deterioration in Europe. We went from 66% of stocks in uptrends to 58% of stocks in uptrends. So fewer companies carrying the day. In Asia, we've seen a small amount of deterioration, 56 to 48. So that's 8% of companies breaking down in price. So those are things that we keep in mind. Now, every company isn't treated the same way. Every sector isn't treated the same way. And we have to look through to see what we can take away. Latin America also, a little bit of breadth deterioration. So we know there has been some consolidation taking place within the market. Market was on an absolute tear from March until January of this year. And certainly some groups have continued on quite well. So let's talk a little bit about leadership. We think our job is to do three basic things. It's to use these breadth tools that we have to identify the areas of the market they're seeing net inflows and focus our attention in those areas. When we do see new leadership emerge or old leadership start to recede, that's our cue to do some rebalancing in the portfolios and be prepared to make changes. That's why we call ourselves an active manager. And then there are some periods where nothing's working. Or all of the models are showing weakness, and we have to be able to play defense from time to time. And that's always a question, especially when the market, continues to make new highs. We do have a view that the bull market is likely to go on for a long time, but at the same time, we know there are some sizable corrections in the context of a bull market. So we want to prepare to be tactically more defensive when that's required. Okay, so let's look at things under a lens a little bit. You can see that since the early part of May, the NASDAQ 100 started to regain some strength and began to rally. So really, from early in the year through until June, NASDAQ really made no progress, but it has reaccelerated within the trend that it's been in, and that's certainly a positive. Companies like Apple and Google and Amazon certainly regaining some strength. When we look at the S&P Value Index over that same period of time, you can see S&P Value Index has basically marked its way sideways now for just about 12 weeks. Now, markets correct two ways, right? They correct in price by price pulling back and resetting, or they trade sideways for a period of time, and through that period, correct excess. You can see this MACD indicator pulling back over the last few weeks to a more normal position, but actually showing that it's been turning positive over the last few days. This is the S&P 500 Value Index, same thing. And then this is a broader indice. This is the Value Line Geometric Index. And this index, this is the NYSE composite, all stocks in the NYSE. Now, this I think is very telling, because while we were correcting this overbought position, it moves straight sideways, and virtually these are weekly bars, and you can see daily bars. Each time we pulled back, market was able to rally back toward highs, and has been really steadily in that sort of sideways range, which we think is quite constructive. Now, things that I think are really interesting. We know that the pandemic hit China hard first, and we also know that China handled the pandemic well internally and really got back to business way before the rest of the world. So what is interesting is that the Chinese market, after its initial rally, paused in September of last year. So now we're like 8 months beyond where it went into a pause. And when we look at price, well, first of all, this range that it was in from 2015, it broke out last fall. but then pulled back into the breakout point. In other words, corrected that first move. And then over the last few weeks has been starting to work its way back higher. It'll be very interesting to see if it can break out above this wedge. But with breadth having turned back positive, we think that's likely. So the first market to start correcting looks like it is starting to move out of that correction. When we look at things that are associated with China and emerging markets, specifically commodities, it tells a similar picture. We saw Rio Tinto, which is one of the largest global producers of various types of base metals and coal, broke out in the fall of last year. We pulled back early winter. We made a new high. We pulled back again making higher highs. And then over the past week, just starting to come out of this consolidation. So we know commodity prices have corrected over the last few weeks. We know that share prices of commodity producers have corrected, but they look like they're ready to start moving higher. And again, held the strength quite well going through that correction. So if China is starting to reverse higher and some of the commodities may start to reverse higher, that might signal a resumption in the cyclicals trade. Now, forget about all commodities like the RJI, which is the Rogers Commodity Index. Let's look at some specific ones. Some of the leaders have already broken out. So this is nickel having corrected and resumed its upward move. When we look at copper broke out, pulled back in this channel, is now just starting to break out of this channel, showing some reversal here. Gold, the same thing, broke out, pulled back, showing some resilience here. Silver looks the same way. We can look at a number of different commodities. Lithium companies really blasted off this week. Some of the rare earth companies really blasted off this week. Certainly energy has been quite strong. So it tells me that it's very possible that we've seen sort of the type of consolidation we needed to see in these companies, and they may be preparing to move higher. This is a point and figure chart of the metals index. This is pulling back, making a low, rallying, pulling back and holding, pulling back, making a lower high, holding at the lows, reversing, and breaking this previous high. So it looks like this group is trying to make a turn. Now let's talk about some of the other cyclicals. The banks, after breaking out from the previous highs, pulled back and consolidated. Last Thursday, had a very high reading of stocks making a 65-day low, which would be a period of time that might be relevant for a correction. That tends to point to sort of a short-term flush in the group. When we look at the industrials, after a similar sort of correction, we got a flush in the short-term data last Thursday. So these have been important groups for us. We haven't seen significant pullbacks in price, but certainly they've been consolidating. Then Friday came. And on Friday, we have 12 stocks up for every one stock down. We have to go back to the beginning of the rally in March of 2020 to have had such a good broad rally in the market. So these tend to be important days. We also saw the percent of stocks in the NYSE above the 50-day moving average turn higher. We saw the percent of stocks above the 150-day in the NYSE turn higher. So we are cautiously optimistic that we may be, working our way through this consolidation. Here are those two indicators turning higher, 50-day and 150-day moving average. When we look at volatility, we've been highlighting the fact that each pullback we've seen has had a lower spike in volatility prices. We're very normalized. This is sort of in the sweet spot as to where markets perform the best. When we look at credit spreads, while markets have been moving higher, if the bond market yields moving down was pointing to a weaker economy, credit markets are not confirming that. Credit spreads are the excess return that a corporate borrower has to pay over a government borrower, are very, very low. So credit markets very calm. And then when we look at the ratio of S&P credit upgrades versus downgrades, well, you can see what the picture is telling us. Market believes things are getting better. So when we talk about leadership, what's changed and what hasn't? Well, we know that if we go back to the beginning of November when the cyclicals really broke out, well, the TLT, which is the 30-year bond ETF, has been about the weakest performer. Really very little improvement here, no major change. The things that act like bonds, the XLU, which is the utilities index, an index of utilities companies that are very low in economic sensitivity, continues really to underperform. So no run to safety here. They continue to underperform. The consumer staple stocks also continuing to underperform. We have seen some improvement in the growth part of the market, coming back to close to where the S&P is for the year. And on the other side, we've seen a little pullback in industrials. We've seen some consolidation in commodities and materials. We've seen some consolidation in financials, and we've seen a little consolidation in energy. So my takeaway is this: while the leaders have rested and consolidated, large cap growth stocks have resumed their strength. And given the way that the market is acting, it looks as though both could participate. Now, I would expect as the year goes along, cyclicals will continue to work their way higher, and growth looks like it can participate too. We have a lot of cash on the sidelines and very easy financial conditions. So as I say, we're always adjusting. And so we know that our largest weights have been financials. We've taken these down a little bit over the last month. And we took our energy weight a little higher, and that's been the strongest performing part of the market. Technology, we added about 5% as they reaccelerated. Industrials have been fairly static. Consumers have been fairly static. Bonds have been fairly static. Utilities, staples, real estate, staples, utilities, and telcos and healthcare, none of which are very economically sensitive, continue to be very small parts of our portfolio and considerably underweighted versus the index. So not a lot of change. A market has to consolidate from time to time, and we think in general things look quite healthy. This is a move from 2 weeks ago to today. Again, a little bit higher in technology. Again, not much change in industrials. We added a little bit to the real estate group, but again, most of the groups really unchanged. So back to the beginning, S&P continues to work its way higher. Don't let it scare you when people say the market is trading at a new all-time high. When markets are in structural bull markets, they make new all-time highs year after year after year. And while there will certainly be corrections as we move forward, and we always watch into the fall for signs of that, at this point, we think things are quite healthy. When we look at valuations, the equity risk premium, and that's the yield the average company makes on its earnings versus what the yield on a 10-year bond is, or the excess return we get for being an owner of equities versus a lender in treasuries, we're getting 246 basis points or 2.4% excess yield on our money versus treasuries. And we know when markets got really expensive, in fact, you were getting almost 300 basis points less for buying equities than you were buying fixed income. We think we're getting paid well for the risk that we're taking. When we look at financial conditions, they continue to be the lowest they've been in decades. In other words, there's easy money in the system. We know they're printing. We know that there's lots of liquidity coming from various cash hoards that can work its way into the market. By one estimate, the money that will change hands from baby boomers to millennials is something in the order of $70 trillion over the next 20 years. The first half of the year was strong. When we take all of the years where the first half was up 10% or more, going back to 1929, in the second half, it tended to be that it was a pretty good second half as well. So we watch every day for things that would cause us to get more cautious. It's unlikely to be just a binary event that is going to affect everything. We watch group by group, geographical region by geographical region, sector by sector. And of course, each one of the positions we own gets reevaluated every day, fundamentally and technically. But as it sits right now, we think it's not the time to be overly defensive. And we think that the conditions are pretty good. So with that, Pam, if there's any questions, certainly happy to answer them.
Well, Dave, you can tell that we're at the beginning of the summer. We don't have any additional questions, mostly because I think you did a phenomenal overview as always. So thank you, James, for joining us this afternoon. And Dave, always a pleasure to see you. And I know our clients and prospective investors always appreciate your overview. So thank you for that. And I will leave you with the final word.
Great. Well, listen, everybody has lots of questions. We get bombarded every day by financial media. We have to remember that most of the people who are talking have an axe to grind. And so if there's something that doesn't make sense to you or something you're wondering about, don't hesitate to call us. We're happy to talk. As you know, one of the reasons why you talk to a firm that is not 1,000 people is because you talk to the principals, and we're always happy to take a call. So thanks very much for tuning in today. Hopefully it was useful. And should there be something in the very short run that needs to be updated, we'll update it through Twitter and our mailing list. If you have not visited on Twitter, it's @BarometerCA is the Twitter handle. If you'd like to subscribe to some of our pieces that we put out on a weekly basis, please let us know and we'll put you on the list. So with that, Pam, thank you very much for moderating.
Always a pleasure.
And everybody try and enjoy your summer.
Thanks so much, Dave. Thanks, James. Bye-bye, everyone.